How seriously do you take the inability of the US to rally yesterday, given we had a positive session in Europe on Monday? We started positively in Europe on Tuesday, but the US couldn't sort of follow through on that positivity. That rally faded. And I wonder how much of it is to do with two micro stories around Apple and their production plans and Tesla and their deliveries, or how much that does tell us something important about the macro.
The neutral answer would be not to read too much. We don't have full participation yet. It's early in the year. Don't take too big a message away from those first few days. However, I'm not neutral on this issue. I think that the next bear market leg in US stocks started in early December, and I think it's all part of that slump. I think over the next few months, we're going to go through the 2022 lows in US stocks. And one of the big reasons for that is that these big name tech stocks are still expensive. They are still overpriced and need to come down lower because the macro environment is going to remain tough. We still have a world of high yields, slightly higher yields we're expecting this year. Even the consensus expects slightly higher in the short term, and we're likely to get a US recession. That means these stocks need to come down lower.
OK, and let's get to Hong Kong and what's driving that. As you mentioned, doesn't show up in the G20, but of course we are seeing great strength coming through on the Hong Kong. The Hang Seng up by, on the Hong Kong market, the Hang Seng up by 2.6% this morning. There's the Ant story, and that does seem to be pretty positive, their ability to raise money. Does it signal something bigger about the market, about regulators moving away from the tough regulatory environment that they'd imposed some years ago?
It does, but I think we've already priced a lot of enthusiasm. So absolutely, I think we're getting an unbelievably clear signal from Beijing that they are prioritizing growth. In everything we're seeing around the greater China story, the Hong Kong story, the China story, what they're doing around COVID, what they're doing around geopolitics, and now what they're doing around the tech companies, the property sector, they are now focused on growth, and they have many tools at their disposal, and they're going to win that story. Now, we've been 2 months into this Hong Kong rally. It's more than 40% up from the lows. We're going to talk about this later on the show. As you know, I'm a very big fan of this story for the last couple of months, and I think it remains a massively unloved story, unloved bull market, which is why it's going to continue for much of this year. At some point, though, I am expecting some short-term pullback. When? Well, not quite yet, and I think that's one of the things is when are you going to look for that short-term pullback? But overall, in 2023, I'm bearish on US stocks, and Hong Kong stocks have much more upside to go.
OK, and as you say, there are a number of signals about the way that the Chinese government is prioritising growth right now. And another one hits the Bloomberg just as you're speaking there, Mark. A red headline saying that China is resuming residential PE funds to bolster real estate. So China resuming approvals for private equity funds to raise money for residential property developments. Another move in the property sector following comments earlier on the property space, and also following conversations around whether China might decide to ease up on its ban on Australian coal. A number of signals that this is where the Chinese government's priorities lie right now.
I think that's the point, is they've been trying to turn more pro-growth for the last number of months, and the market was just ignoring their efforts. Now they've gone, you know what, let's just throw the kitchen sink in it. It nearly reminds me of what they did back in 2009 when they turned the kind of global economy around with their massive infrastructure impulse. They've gone in every way across the board. We're going to make it easier. We're easing up on geopolitics with the US, with Australia. We're easing up on COVID restrictions. We're easing up in the tech sector, which is real kind of a flagship of what they were kind of targeting, their kind of attack, supposed attack on capitalism. They're easing up in the property sector, which is really what they kind of wanted to worry about, the credit bubble. They've gone, we're no longer worried about the credit bubble. We want to get growth back on track. We want to get assets recovery. It's an unbelievable message, and I think it will last this year. It does not mean it will not come without volatility.
OK, and we haven't had time to mention, but we will mention later on in the hour whether the standoff in US politics has an impact on maybe US borrowing costs, the debt debate over in the United States, the inability to elect a speaker, whether that has an impact on markets. We'll get to that a little bit later on in the programme. Thanks to Mark for thoughts so far. Remember, you can get up-to-date analysis and insight from Mark and the rest of the Markets Live team. MLIV Go is the function to use on your Bloomberg terminal to keep across the Markets Live blog.